Hi everyone, welcome to part B of chapter 1, the accounting in business. In this chapter we're going to start looking at financial statements, and financial statements are what reflects the business's transactions. So everything that happens within a month or within a year in an organization all gets put into financial statements so that you know the financial health of your organization. Okay, so an organization's primary means of financial communication, as I say, are the financial statements. So there's internal users of financial statements, so the owner, the manager, the accounting staff. There's also external users of financial statements, which would be Canada Revenue Agency, the banks, and anyone that's looking to invest in your organization. All of this was mentioned in the last section, but just as a reminder. So there's 4 major financial statements. There's the income statement, the statement of changes in equity, the balance sheet. Those are the 3 main ones that we're going to be talking about. And then there's also a statement of cash flow. And the statement of cash flow is the way it sounds. It's what's happening to the cash in your organization. Where is it going and where is it coming from? Okay. So the income statement, and as you can see here, the balance sheet is what we start with from the beginning of the period. So if it's a brand new organization, your previous balance sheet is going to have 0. Okay, so when you start your company, it starts at 0. Then you're going to have your income statement. And your income statement, its main purpose is to let you know whether you have a profit or a loss. It records the revenues or your earnings. So if you make a sale, so for example, in this course, we're talking about services. So say you mow lawns and that's your business. Your revenues are what you charge your customers for mowing their lawns or plowing their driveway. Okay, and then the expenses are how much it costs for gas, rent, your cell phone expense, insurance expense. And then once you have your income statement, you've got your revenue minus your expenses, and then that's going to tell you what your profit is. Hopefully a profit. It could be a loss. If your revenues are less than your expenses, then it's going to be a loss. But in most organizations, hopefully revenue is going to be a higher number than your expenses. And this is an example of an income statement. So as you can see, there's revenue. So in this case, there's it's a type of organization that sells both food services and earns teaching revenue. So you've got your food services revenue plus your teaching revenue to give you the total revenue. Then you have your expenses, or in this organization, they're calling it operating expenses because it's the expenses that they incur to operate their business. We have rent expense and salary expense. So the total operating expenses are $1,700. The total revenue is $4,100. So $4,100 minus $1,700 gives you a profit of $2,400. Then we have our statement of changes in equity. Okay, so equity is the worth of the organization, and the way equity changes is by having profits or loss. It gets recorded in our statement of changes. You'll be able to see this in a moment when I show you what it looks like. But also another way that equity can increase is if an owner invests money into the organization, and equity decreases if the owner withdraws money from an organization. Okay, and when we're talking about a sole proprietorship, A sole proprietor cannot list themselves as salary expense or wage expense. Even if they work for the organization, they have to actually take the money out as an owner's withdrawal, which would directly decrease the equity in the organization. So here's an example of a statement of changes in equity. You have the opening balance. So in this case, it's Haley Walker that owns the organization. So the capital, so we're doing it for the month of March. You can see March 1st is 0, and it's for the whole month of March. So during the month of March, the owner invested $10,000 into the organization. They carried forward the $2,400. So if we go back and have a look at our income statement, we had a profit of $2,400. So we add the $2,400 in. So then we've got $12,400. Then the owner withdrew $600 from the organization. So now we have an ending Haley Walker capital on March 31st of $11,800. So now that we've created our income statement, and as you can see, the profit from our income statement becomes part of our statement of changes in equity. So our statements are linked together. Okay, so now that we have our statement of changes in equity finished with an ending capital amount or owner's equity amount of $11,800, we're going to see how that goes on our balance sheet in just a second. So a balance sheet is where we report our assets, our liabilities, and our equity at the point in time that we're doing. In this case, as you saw, we're doing March 31st. So assets are properties or economic resources controlled by a business. So for example, cash, accounts receivable. An account receivable is money that's due from a customer. We're due to receive that money from the customer. We've got supplies, we've got equipment, we've got buildings, we've got vehicles, we've got land. Those are all assets. They're items that stick around for a while and have continued use within the organization. Okay, like cash, accounts receivable, supplies. Then we have our liabilities, and our liabilities are debts or obligations of a business to transfer cash or other assets as a result of past events. So for example, our power bill, okay? So we get our power bill in the mail. That's an expense because we used power. But if we haven't paid for it yet, then it becomes an accounts payable. I'm due to pay this at a future period. Okay, so maybe 30 days from now, I have to make sure I pay this or it'll be overdue. We've got notes payable, we've got interest payable, we've got salaries payable. So if our employees have worked and it's not payday yet, we're due to pay them. So there's salaries payable. And then of course we have income tax payable. So if we have a look at our balance sheet, you can see here, it's double-sided. So you can see the assets are on the left side with total assets, and then we have liabilities and equity on the right side, and those two are added together. And you can see on the bottom we've got total assets, and we have total liabilities and equity added together, and they both equal $18,000, okay? That's our balance sheet. We know that they balance, okay? And again, we have assets, we have cash, we have supplies, so maybe those are books, or if it's a car dealership, maybe it's parts for the cars. Maybe it's cleaning supplies if we're a cleaning company. Then we have equipment. It could be photocopiers, it could be computers, it could be manufacturing equipment. We have liabilities. Okay, so we've got our accounts payable, we've got our notes payable. Those two added together gives us the $6,200. We bring our $11,800, remember from our statement of changes in equity, there's our $11,800. So we link that down here, add those two together, and that gives us our $18,000. So our balance sheet balances. Statement of cash flow, I'm not going to get into this one too much, but what it does is it covers where our cash has gone in an organization or where it's coming from. Does it relate to our day-to-day operations? Does it relate to us making investments? Does it relate to us financing activities such as getting a loan to buy a new piece of equipment? And if you want to have a look at these summaries, they're in the PowerPoint presentation. But it gives you the elements of the financial statement summary. We have the assets, we have definitions, characteristics, and more examples. Again, more examples of liabilities, more examples of your equity. Okay, so again, for our statement of changes in equity, we increase our equity, and the increase in equity is caused if the owner makes an investment. So whether the owner maybe invests $10,000 of their own money into the company, or there's a profit coming from our income statement. Decreases in our equity are caused by owners withdrawing money from the organization. Because remember, in a sole proprietorship, that's how the owner gets money out of the organization. They're not allowed to take it as a wage expense. They do it as withdrawals. But another way that the equity decreases is if instead of a profit from our income statement, we incur a loss. So coming out of this section of our chapter, you should know what are the four major financial statements. You should be able to describe revenues and expenses. You should be able to give examples of assets, liabilities, and equity. And we didn't cover this part, but what are three differences in financial statements for different forms of organizations? Okay, so if you want to have a look at this slide here, that's a minor part, but it may be covered in the Smart Book. Okay, so equity on the balance sheet belongs to the sole proprietor, partners, corporations, so you can see there's a few little differences. Thanks everyone. Let me know if you have any questions.